Hey everybody, welcome to this free edition of our Trader Use Group Weekly Roundup for the trading week ending January 31st, 2025. The first month is in the books. I'm Preston Brent. Thanks for tuning in. Well, interesting end of the month. Let's just kind of take a look at where we've been and what looks like and where we're going. Most of the stocks this week in the U.S. finished, it was a volatile week, mostly lower. Although the Dow did manage, as you can see here, to notch its third weekly gain. Nasdaq, Russell, S&P all in the red for the week. Year to date, however, everybody's in the green. Dow's leading the way, 4.7%. S&P is bringing up second, 2.7. Russell third, and Nasdaq coming in last, but all in the green for the week. We did have a big steep drop on Monday. It was driven mostly by a sell-off in tech stocks when the emergence of DeepSeek, it's a Chinese artificial AI developer, they came out and said they could do everything for under 10 million, which now in hindsight, a lot of people believe that they didn't really do it that way. But either way, it does show there's competition out there in the Asian markets for AI, and that is going to reduce some of the spend that's going forward for AI. Meanwhile, earnings season continues to roll along. Companies representing about 40% of the S&P market cap reported results this past week. And then in the second week of the Trump administration, just a ton of executive orders, political headlines, a lot of things that can influence market sentiment, particularly the administration's plans for global tariffs, right? I mean, that hit on Friday and caused the markets to reverse a strong gain for the day and turn it into a red day for the markets, and helping move the markets lower for the week for most of the equity markets. Basically, Trump came out and he reiterated his plan to impose 25% tariffs on Mexico and Canada starting this weekend, Saturday. Those are two of the top trading partners for the U.S., and he said he'll do it by February 1st. This weekend, and then he also looking at putting an additional 10% levy on goods from China, enough to move the markets lower. As you can see here, the PE ratio, the forward PE ratio, is still very high at 22.33. Dividend yield is at a low 1.22%, but the 10-year Treasury is still at 4.54. So the earnings yield of the S&P is 4.5. 10-year Treasury is 4.54, so that does put a lot of money into the U.S. debt market, and it's considered risk-free at 10-year Treasury, so it does tend to draw money away from equity. And then the VIX finished out the week up a little over 10.5%, closed out the week at 16.43. The other thing we got this past week, the Fed's concluded its first meeting of 2025 this past Wednesday and announced that they're going to be holding the rates steady at 4.25% to 4.5%. No one actually was expecting a rate cut. And he really tried not to make any news, which he successfully did. That would be Boom Boom Powell, our illustrious Fed chair. So that was kind of a benign event. Most of the market is not anticipating a rate cut in the next meeting, which isn't until March. So we're going to see where that winds up. We also saw core personal consumption expenditures, PCE, it's a Fed preferred measure of inflation. It rose 2.8% year over year in the month ending of December. That's the third consecutive month that it's accelerated just a little bit. It was 2.7 in September. So it's not moving towards the 2% level. And the Fed's long-term core PCE, their target is 2%, all right? So we did also see on Thursday, U.S. first pass GDP for Q4 came in at 2.3%, all right? 2.8% is so far for the full year, but it does show that slowing down as well, okay? So we're getting some slowdown in the economy. You can see the best performer for the week was communication services, up 1.96. The worst for the week was technology. They took a really ugly bath early in the week, and they didn't recover for the week, down 3.5%. Annually, healthcare is leading the way, a strong, robust 6.76%. Technology is leading the way to the downside, but we're only 1 month into the new year. Okay. If we swing over, look at our cousins across the pond here. If we look at Europe, you can see very strong to start the year. This is one of their better starts of the year, even though they're screaming that they could have a recession, stagflation, a whole host of measures. You can see the Euro stocks, FTSE, CAC 40, DAX, all in the green weekly, but year to date, I mean, they're 7.99% for the Euro stocks. That's the 50 largest companies across Europe. The FTSE's over 6%, CAC 40's over 7, and look at the DAX, over 9%. Very strong start. Now, a lot of that is a bounce from an ugly year last year. But either way, we are seeing a little bit of strength in a very dismal period across Europe. ECB this past week, this Thursday, I think they cut their rates by 25 basis points to 2.75%. All right, so they're willing to cut the rates, whereas the Feds right now are not. We did see also the Eurozone economy, it stalled a little bit in the final 3 months of this past year. It fell short of consensus expectations, had a 10 basis point expansion. So for all practical purposes, the full year growth for Europe last year was only 70 basis points. Okay. And we did see the largest economies that make up the ECB, that'd be Germany and France, they actually contracted in Q3 and were relatively flat in Q4. So they're even though the markets are up, markets are betting on a bounce. The economy across Europe's not that good. And then, of course, if we come over and look at the Asian markets, you can see here in Japan, stocks were pressured. Bank of Japan, they raised their rates third time within 12-month period by 25 basis points. Okay. And they did this on expectations that they believe that inflation is continuing to move higher across Japan. The yen strengthened also the high end of the range for the yen and the dollar. It was around 154 to 155. So that, and as you guys know, I've been bullish the yen, knowing that the Bank of Japan is going to be hiking the rates. We'll take a look at the chart in a minute. And finally, China, you can see there, they were in the red, like Japan, weekly and year to date. Okay. The markets in China, though, big holiday, they got their New Year's. They've been closed from January 28th till February 4th. So early this coming week, they'll still be closed. And then their trading kicks back off on February the 5th. Okay. Data did show that China's economy kicked off 2025 on kind of a weak note or weak footing. Their PMI fell to 49.1 in January. And their non-manufacturing PMI, the services PMI, that slipped to 50.2. So most of the analysts believe that China is going to have to put a lot more money into that economy to continue to stimulate it. Okay. We also saw profits from some of their larger industrial companies fell about 3.3% in 2024. So that's the third straight year of decline. So China's got their work cut out for them. What I want to do is switch your screen over to charts. Let's go take a look at the E-mini S&P 500 futures. And you're going to see a daily chart of the E-mini. And although we finished in the red for the week for the S&P by 1 percentage point, you can see here that we moved up, but then we came back down again into close on Friday. We closed down 33.75 points. You can see the all-time highs were last made on December 16th. We're in the green for the year. We hit my target down here, and I think we're going to stay stuck here. Depends on where we get earnings coming out this week, and just how everything pans out. We got a lot of companies coming out with earnings this week. We also have this week we got Amazon and we got Google, so we're going to be rounding out those, and then we save the best for last in the video the following week. All right. If we come out here and look at Nasdaq, you can see the Nasdaq chart. We're above the 50 EMA. You can see it held up here. But again, that candle would seem to indicate to me that we could have some more downside in Nasdaq, just barely off the flat line from a close of last year. Okay. And if we look at the Mag 7, just this ETF tracks all Mag 7. You can see here again in the green, but just barely, right? And we're not really going anywhere on any of these. And of course, if we look at the FANG index actually was making new all-time highs on Friday and then pull back with that pullback with the tariff news as we rounded out the end of the day. Although I am seeing some bearish divergence here. So that does tell me that technology could continue to be weak going into next week. And if we look at the value over equal weight over cap weighted, you could see here that it's just barely off zero. Okay. So that means that we're still getting the favored 10 semi outperforming everybody else. And then, of course, if we look at the Dow futures, you can see here the Dow futures actually was off new highs. In fact, all-time highs on Friday and pulling back. So Dow, as I told you, it's up 4.7% year to date. It's leading the way, and there is no divergence here. So typically when Dow leads the way, they got more larger industrial, global, and value-oriented companies. So it just seems that some money is starting to seek some safety in some of these types of larger mega cap indexes. If we come down here and look at volatility, because I want to show you the VIX. If we look at the front month skew, we're in the green, all right? So we're in a normalized, even though the vol popped a little bit on Friday, we're still in a contango environment. And if we look at the back month skew, comparing February and March, vol futures, solidly in the green, all right? So I don't see any fear in the volatility marketplace just yet with the onset of tariffs coming. If we look at the 10-year interest rate, you can see as we round out Friday, it is moving down just a little bit, which is a good thing. Okay, this is a 10-year yield, closing out the week at 4.54, roughly 4.56, roughly in that area right there. Okay, and of course, if we look at the bond market, it was still in the green for the year, but still relatively low. I'm expecting this to move a little bit lower, which means rates moving a little bit higher. Of course, if we look at the US dollar, the dollar index, you can see here the dollar index is just barely holding on to the green for the year. Pull back a pretty good little bit, barely holding on. If we look at the euro, you're going to see the euro is in the red for the year. Okay, I think the euro is going to move a little bit lower. I think the dollar is going to move a little bit higher. You can see my forecast for the euro is to move actually near parity with the dollar going out the next 60 to 90 days. But my favorite is the yen. The yen, I've told everybody start looking at long positions in the yen. My target for the yen was down around here. Okay, but we had a good little cross here. We're moving out of this regression channel here. But look at what it did on Friday. It could not hold a 50 EMA. Same pattern is right here. If we can get a hold over the 50 EMA and then have a follow-through day, then the yen to me makes sense to the long side. Okay. We look at gold. Well, gold is moving up, although Friday it was down. You could see we had all-time highs in gold on Friday, and it moved down just a little bit, but we were up 28.62. Okay. I think gold's going to go higher, right? It's sniffing something out in the market like interest rates in the bond market are. That is not longer term, not that good. Near term, I think we do have a little bit of that money or a lot of money flowing in from the Asian markets and European markets into the U.S. markets. So that is helping our long positions. But be very careful here. All right, members, we'll go through some specific stocks and opportunities as I see them right now. And you can look at the silver. Silver is also up well over the 50 EMA and the 200 EMA, but it's pulling back a little bit. But I do like silver and gold longer term, right? I think that's going to be a good play. Of course, if we look at oil, oil is almost $74 a barrel, but it pulled back up here. I didn't see oil holding that level very long. Okay, I just don't see it doing that. I don't think oil is going to move up too much. It's got to get over it's sandwiched between the 250 EMA, which are almost parallel in each other. I think the more logical movement for oil is sideways chop, maybe down just a little bit. Nat gas off the highs. That was an easier play here. Look at going short. Nat gas up here. All right, and now it's down over here. This is not a trade down here. I think it can be choppy up and down every day. The trade was back over here when I said, look at going short nat gas here. All right, everybody, that's a real quick and dirty on some of the major commodity and asset classes as well as the U.S. indexes. Members, I will see you this Sunday evening for a little bit more detail on some of the markets and some of the things that I'm seeing shaping up for us. All right, everybody, have a great weekend. Ciao, everybody.